Stay informed on earnings trends and analysis in Zach's Earnings Outlook.
Well, it seems as though that happy feeling over the Q1 earnings season has changed a bit, at least for our research director, Shiraz Mian, who's here with me now, to kind of clarify things. So there we were, going along, all happy,
Sure.
right? It was going to be a rosy Q1 earnings season. And then you noticed something that you keyed in on that many other people who watch didn't or haven't yet keyed in on. And that is, despite all the profit and sales beats this Q1 season, estimates for the second quarter have remained static.
That's right.
Why does that concern you?
Well, for one, we stay focused on estimate revisions because that's at the core of our business. The Zach's rank, the key driver for that is trends and estimate revisions. But what concerns me by not seeing enough estimate revisions for Q2 is that since the second half of 2017, one of the primary and major narratives we had about this positive earnings outlook was this improving revisions trend for estimates. And you would recall that ahead of the start of the Q1 earnings season, we had some amazing positive estimate revisions. So Q1 estimates had really gone up. So had estimates for the remainder of the year. And a big part of that was the tax cuts. But there were, I personally thought that I saw from data non-tax cut momentum in estimates too, and I'm just not seeing that in estimates for Q2, and that's why I'm a little less enthusiastic than some of my peers.
And that's not to say that that is typical behavior for the first quarter of the year.
No, it's not. We have to be mindful of the fact that over the last 5-6 years, the normal behavior for every quarter has been that as the earnings reports for one quarter come in, estimates for the current or coming quarters will start going down. So what we thought since the second half of 17, particularly what we saw ahead of the run up to the Q1 earnings season, that we have totally gone from that trend, meaning that the trend now will be for estimates going up. So that was the change that we saw, the negative change.
And is this why we've been seeing the stock market not reacting favorably to stocks of consensus beating companies?
My theory on that, Terry, is that the positive and very strong growth that we saw in Q1 and what's expected in the coming quarters, all of that was already priced in. So a big part of why the market remains unimpressed is the fact that the incremental change, the change for the coming quarters, is exactly what it was ahead of the start of the Q1 earnings season. So Q1 earnings are very good. But what's happening to Q2 and the following quarters, those estimates aren't changing or aren't changing in a positive direction. In fact, estimates for Q2 have a tad bit come down. So the change on the margin is either negative or none whatsoever, and that, in my judgment, is why the market is behaving the way it's behaving.
So I'm going to have to play devil's advocate here for a minute. Does this all mean that earnings growth may either be slowing going forward, or worse yet, that earnings, as far as the stock market is concerned, don't matter anymore?
Well, earnings always matter. In fact, if you step back from the day-to-day movement of stocks and look at longer-term trends, there's just only two variables that drive stocks. One is earnings, the other is interest rates. So as we discussed earlier, Q1 results are very good, but there's no change in estimates for Q2 and the following quarter. So if those estimates had been going up, then you should have been seeing some follow through in the stock market as well. So the way I see it, the market's relatively tentative reaction to the very strong growth numbers in Q1 and no revisions to Q2 and the following quarters, or modest cutbacks to revisions, makes perfect sense. With respect to your other comment about growth having peaked, I think that's a fair comment. We are on track for about 24–25% earnings growth. We will get strong growth in the following quarters too, perhaps in the mid-teens range. But I'll be surprised if we surpass the growth rate that we saw in Q1.
All right, bring us up to date on the scorecard.
Okay, so I have this this slide for folks. 457 or 91.4% of the S&P 500 member companies have reported results. Earnings are up 24.5%. Revenues are up 8.9%. 77.5% are beating EPS estimates. A very strong 74.6% are beating revenue. Underneath that statement, I have the comparison table. So I'm comparing the growth we have in Q1 to what we had been seeing in other quarters. And you could see in the left-hand chart that the growth in Q1 is magnitudes better than what we had been seeing in other recent periods. The proportion of companies beating estimates in Q1 is about in line with what we saw in the preceding quarter, in the fourth quarter of 2017, but better than historical periods. So a very strong showing as the overall narrative on the Q1 earnings season has been.
And as we speak here now, the retailers are reporting their earnings.
That's
They're
right.
typically the last to report in the cycle. What's going on there?
So we had the way we group and segment the retail group as a whole. We have a standalone sector for retail here at Zacks. And the retail sector that we have, in addition to the traditional Walmart and Macy's and Home Depot, by the way, Home Depot reported results this morning.
Yep.
Walmart, Macy's, and the others are on deck to report results in the next few days. So we have the online vendors, the Amazons off the wall, the restaurants, McDonald's and stuff, and then the traditional retailers. So the online players and the restaurant players have reported results already, as you could see in this slide. We have 20 of the 38 S&P 500. The retailers in the S&P 500 have reported results already. Strong growth for the retailers that have reported results already. 24.8% earnings growth, 13.6% revenue growth, 70% beating EPS, 60% beating revenue estimates. So overall, as strong a growth showing as we have been seeing elsewhere, but you could see that the proportion of these retailers beating estimates is tracking a bit lower relative to other recent quarters. We'll see what the traditional operators come out with results in the next few days, but the overall growth picture looks good.
So, are we finally seeing the full impact of tax cuts on companies' bottom line?
I think we do, yeah. The 25% earnings growth and also the positive revisions that we saw to estimates for the remainder of 2018 in early January, in February, was to a large extent a function of the tax cuts, and then the very strong growth we are seeing in Q1, both in terms of earnings and the improvement that we are seeing in margins. All of that is the impact of tax cuts.
What are you looking for Q2 and beyond?
So I have this slide which puts the Q1 18. The 23.9%, this is the blended growth rate for the quarter as a whole. And then we have the next 3 quarters, including Q2, 17.6% earnings growth is expected in the June quarter, and then 18.9 and 15.7 in the next 2 quarters. So still very strong growth, but as I mentioned earlier, the expectations for Q2 haven't really changed much. And I have a slide just to show how these growth expectations for Q2 have evolved. In early March, Q2 earnings were expected to be up 17.8%. They are now expected to be up 17.6%. So the growth picture has a tad bit weakened relative to 3 months back. And that was the concerning part that we were discussing at the top of the segment.
Let's just say, for the sake of discussion here, that estimates for quarters yet to come also remain static. Is there a bigger concern then if that happens?
I think it is. I think the overall positive story that we had priced in the market and that we thought will become an enduring support for stocks, then that argument and narrative gets weakened in a major way. That would indicate that the gains are now behind us, and the market will need a new catalyst and a new support to push it higher.
All right, mixed bag.
That's right.
Is what we're looking at here. Thanks for that, and we'll be checking in with you probably the next time around. Don't forget, in the meantime, in between these video chats, you can always read Shiraz's comments in his twice weekly commentaries that he pens by his own hand. Monday's earnings preview tells you what, if any, earnings are coming up in the ensuing week. And then generally Thursdays, his earnings outlook, which is a full-blown piece on the aggregate trends, earnings-wise, of the S&P 500 reporting companies. You can find all that on our website, Zacks.com. With Shiraz, I'm Terry Ruffalo.